Capital is redrawing the real estate map, and scale, not sector, is now the decisive advantage. Good morning. This is the CRE360 Signal Daily Brief for Monday, November 17, 2025. Here's how real estate market is moving today. BlackRock and Spain's ACS have launched a $27 billion joint venture to develop and operate global data centers, marking the largest single capital deployment in the sector's history. This partnership accounts for over 40% of the $65 billion invested globally in data centers last year, according to MSCI Real Assets. The shift is a direct response to surging demand for digital capacity, propelled by artificial intelligence and cloud computing, and a reaction to muted returns in traditional CRE. The move underscores how institutional capital is now targeting digital infrastructure as a secular, not cyclical growth play. Cap rate spreads for digital infrastructure have narrowed by 40 basis points, even as spreads for office widened by 85 BPS, per CBRE Insights. Regional players are being squeezed out of the bidding for land and power, as global sponsors aggregate sites and resources at scales previously unseen. For CRE professionals, the message is clear. Fulfillment and automation are the new engines of value. Lenders and investors are increasingly underwriting retail assets based on logistics adaptability and supply chain resilience, not just foot traffic or sales per square foot. Turning to industrial, regulatory, and trade headwinds are now dictating procurement and property strategy. Tesla is shifting its U.S. supply chain away from Chinese components, reacting to federal policy proposals that could tie EV tax credits to domestic sourcing. Last year, the U.S. imported over $11 billion in auto parts from China, U.S. Census Bureau. Pending Treasury guidance would limit credits for vehicles with foreign content, driving Tesla and peers to reconsider supplier contracts and logistics networks. The likely result could be increased demand for domestic suppliers and industrial assets near EV assembly corridors, while cross-border providers face contract risk and potential facility underutilization. Supply chain resilience is no longer optional. It's a core underwriting criterion. Looking ahead, we expect more mega-scale JVs in digital infrastructure as demand for AI and cloud accelerates. We would also watch U.S. regulatory developments around EV supply chain sourcing for industrial demand signals, and monitor retailer capital flows into logistics and fulfillment, especially among omni-channel leaders. Credit and policy shifts may further favor infrastructure and logistics, tightening for legacy CRE. For the full analysis and subscribe to our newsletter, visit CRE360.ai.